Good evening if you're in Japan or elsewhere in Asia. Good afternoon if you're in Europe. Good morning if you're in the US. It's my pleasure to introduce this new and last session of financial statements for the year 2020, which was also the first year of that series at the Peterson Institute. I'm Nicolas Véron, and today we will discuss Japanese issues, or rather global challenges, but viewed from Japan. We'll do that with Professor Takeo Hoshi of University of Tokyo and Takeshi Tashiro, who is a visiting fellow at the Peterson Institute and also works now at METI in Tokyo, the Ministry of Economy, Trade and Industry. Professor Hoshi studied at University of Tokyo and then at MIT. He spent a significant part of his career at the University of California in San Diego from 1988 to 2012. He also had visiting positions at Osaka University and the Bank of Japan in that time. In the 2010s, from 2012 to 2019, he was at Stanford University, and he moved back to Japan last year at the University of Tokyo. He's one of the most prominent experts on the Japanese economy, and with particular recognition for his insight on the Japanese financial sector. He's the author of the reference textbook on the Japanese economy at MIT Press, together with Takeshi Ito. And he also has another book forthcoming in a few weeks, I think, with Philip Lindsay on the Abe administration, so early next year. Takeshi Tashiro studied at Keio University in Tokyo. He entered METI, the Ministry of Economics, Trade and Industry, in 2006, and has been working there since, with two interruptions. One in the early 2010s when he went to Harvard Kennedy School for a Master's of Public Policy, and the other one, most importantly for me, for year 2018-2019 at the Peterson Institute, and that is of particular relevance from my standpoint because we shared the same office. So it was a fantastic year to spend together at the Peterson Institute before the pandemic, before Takeshi flew back to Tokyo and before the pandemic hit. He has a book published by Nikkei in 2017. Here's the book. On a roadmap for ending Japan's stagnation. And right now he's working a lot on sustainable investment and how to promote it in the Japanese economy at METI, but remains affiliated with us at the Peterson Institute. And I should mention that he will speak today in that latter capacity, not on behalf of METI or the Japanese government in any way. With that introduction, we'll discuss today a topic which is of major relevance right now, which is the zombification of firms, banks, and the economy. And this is now an issue which may affect, or maybe is already affecting, a number of economies around the world, in the US, in Europe, and elsewhere, but on which Japan, experts from Japan may have some good advice, because Japan was, in the 1990s, the textbook case of zombification. The expression was not invented in the context of Japan. It was invented in the context of the US in the late 80s. But it is with Japan that it became, I think, mainstream in economic analysis. So we're very keen to hear from Professor Hoshi and Takeshi Tashiro on zombification and how we should think about it. Takeo, the floor is yours.
Okay, thank you, Nicolas. Thank you for the kind introduction. I prepared some slides, so let me share that with you. And I assume you can see my slides. Does that look okay? Good, good. So it's my pleasure to share with you my observations and thinking about economic policies in Japan. And this is about Japan, but as Nicolas pointed out, I hope it is also relevant to many countries which are suffering from COVID-19 recession, and try to try doing several policies to get out of those. Since I have only 10 minutes or so, I want to jump right into the discussion, which means that I'm skipping the slides. Okay. So this is my main argument. This slide summarizes what I want to talk today. I argue that Japan's policy responses to the COVID-19 crisis have been basically the same as the responses to any other large macroeconomic shocks, including the global financial crisis 10 years ago and the Japanese banking crisis that preceded the GFC in Japan. And Japanese responses have been pretty much similar this time. And what I especially focus on is liquidity support for corporations. The main goal of such policy for the support for corporations is to protect employment through protecting corporations when a negative macroeconomic shock hits the economy. And the protection of employment is, of course, important, and I don't have any complaint. What I want to question about Japan's policies to protect employment through protection of corporation is a way that the Japanese government do this. Mainly, they protect corporations in order to protect the employment of the workers. And I argue that the policies that protect corporations to protect employment, it makes sense when the negative macroeconomic shock is temporary. If everything goes back to normal after a while and the economy will look exactly the same, it makes sense to preserve everything as it is. But this is not the case for many major crises, including global financial crisis, Japanese banking crisis, and also COVID-19 seems to be different from just a macroeconomic shock, but it also contains important permanent changes. So the protecting the status quo may not make sense. So I point out two problems of trying to protect status quo or protect incumbent firms in Japan in order to protect employment. And first, it doesn't do a good job protecting employment after all. Only a limited group of workers is protected. And this is because this is related to the practice of what is called lifetime employment system in Japan that covers only a limited group of workers. And second, as Nicolas pointed out, protection of the incumbent firms can create zombie firms that harm the economic growth. And I will elaborate on these 2 points. Okay. So the first, this slide shows one aspect where we can clearly see the massive liquidity support by the Japanese government during the current crisis. And Japan is, of course, not the only country that is providing liquidity support. But as a result of this policy in Japan, the total bank loans, which is on the right side of this figure, have increased by about 30 trillion yen since the pandemic started. And this growth is actually higher than during the global financial crisis or the Japanese banking crisis. And so far, the policy seems to have worked. This slide contains 3 graphs. The upper left is a number of corporate failures. So the corporate failures are kept low during the current crisis, which is a blue line. And especially in May, the number of corporate failures actually fell. The lower figure shows what happened mostly in the global financial crisis. Back then, the Japanese government helped the corporations too, so that the Japanese banks didn't see the non-performing loans increase very much, even though the recession was very, very sharp. And for the right side of the slide, there's a decline in employment in 3 crises: the Japanese banking crisis, global financial crisis, and also the COVID-19 situation today. And the employment growth has been negative, but these are low numbers compared with, for example, the rate of population decline in Japan. The Japanese population has been declining about 0.5% annually. So compared with that, the job loss or employment decline of 0.4% is not that large. So in this sense, the Japanese government, if they try to protect the employment, we can see they succeeded in doing that by protecting the corporation. But it turns out there are two problems, I argue. One is that the policy does not actually do a good job protecting all types of jobs. Only a limited group of workers that is covered by the practice of lifetime employment in Japan is protected. I don't get into what lifetime employment system in Japan. If you're interested, you can, of course, read my textbook with Takaito. But the problem of the lifetime employment system in Japan is that it only stabilize or protect the part of the labor market, which are the workers who work for large firms and at the full-time basis and often male. Okay, so when the macroeconomic shock hits, when the recession hits, these regular workers in large firms are protected, but non-regular workers, especially at small firms, are not. And the problem seems to be already observed in the current crisis. This table shows what happens to a different type of groups of workers in the global financial crisis back in 2009 and also 2020. And you can look at the column for the 2020 and we can see the female workers lost more. Non-regular workers, their employment got lost, and the smaller companies lost their employment more than the large companies. So only a part of the labor market is protected by the Japanese policies to protect incumbent corporations. And the second problem comes from protecting the firms that are not viable in the new normal. The loans extended to cover liquidity shortage will stay even after the economy recovers and cause a debt overhang. And as the liquidity support turns into the solvency support, or the liquidity problem turns into solvency problem, it creates a possibility of creating zombies. And as Nicolas pointed out, the problem of zombie firms in Japanese banking crisis has been studied by many people, including myself with Ricardo and Neil. The problem of zombie firms after a global financial crisis in Japan has not been studied very much. So this is where we need more research. There are many papers that actually study zombies in Europe after global financial crisis. So, and they found similar problem of zombie firms depressing productivity and growth in Europe, in addition to Japan in the late 1990s. So that's a problem of protecting incumbent corporations in order to protect employment. So summarizing this argument, looking at Japan's policy, I worry if we are making the same mistake again. Avoiding too many bankruptcy may be the right response during the crisis, but can impede the adjustment to new normal. And of course, the pandemic situation is far from over, and the Japanese government can change the policy as the health situation is stabilized. I'm not sure when that happens. And the economy urgently needs a restructuring for the new normal, but I'm not sure if that happens. So today, so that's a main argument I want to make in my 10 minutes. And this is a question I would like to discuss with Takeshi, Nicolas, and all of you. Basically, will the living dead return to Japan or not? And I'd like to end my remark by looking at one more figure. And also, I also list a couple of points that we need to we need to think about too. But let me finish by looking at one picture, which actually question my argument that the debt overhang can be a serious problem. This figure shows the increase of corporate debt, which is a blue line and measured on the left axis, and also increase in cash and deposit held by the corporation, which is measured on the right axis. And the point of this figure is it's true that the Japanese corporations increase the borrowings, increase the debt, but at the same time, they increased a lot of cash and deposit as well. So net debt may not have, net debt has not increased as much. So the increase in net debt is not that big so far, and maybe the problem is less serious than I sounded. And let me stop here, and we can come back to these discussions later.
Thank you so much. I think given where we are in the sequence of the pandemic, ending on a question mark is perfectly appropriate and a great start for our discussion. So Takeshi, over to you.
Hi, thanks for having me. I'm really glad to be able to return to Peterson Institute. It's virtual, but it feels like I came back to my home. So today, I would like to talk about my personal views on COVID and zombie. I do not represent any views of organization I belong to. Hoshi-san, nice to meet you. Your discussion is very compelling. You rightly pointed out the risk of zombification after the COVID. I think it's really important issue. And I agree with the assessment of the policy responses and the need for transformation of industries. I would like to discuss on COVID first. I would say that COVID reveals the weak points of each countries. In Japan, those are inequality and unproductive industries. One takeaway from this presentation is that the reforms Japan has promoted in the past decades are unfinished. I mean, Hoshi-san pointed out the vulnerability of particular types of workers, and the damage was concentrated on female and non-regular workers. That might be because lifetime employment system that Hoshi-san mentioned, but I would say that more female work for the service industry, which was hit by the COVID, and more female employees work as non-regular as well. These are one example of inequality, I think. I mean, Japan has promoted womenomics, which raises female participation rate, female labor participation rate. It is now higher than US and some other European nations. Womenomics has been effective because without womenomics, things could have been much worse. So we should continue this successful approach, but increasing participation is not the goal. There's room to improve quality. As for industries, Japan's service industry is low productive. COVID is a chance for Japan's business transformation that Hoshi-san mentioned. Japan indeed recognizes it with its stimulus packages. Suga administration is pushing digital transformation, kind of like post-COVID transformation. Prime Minister Suga is going to create digital agency, promote green investment, and cut red tapes. So Japan should, and other countries should too, make this crisis as an opportunity. These are my comments on COVID. So let me turn to zombie. I agree with what Hoshi-san said. Zombie company, the risk of zombification shows the challenge of Japan's social security system. I think one alternative approach may be to have a strong social security system. I mean, once people get unemployed, a strong social security system will help them get new jobs or retrain them to get new skills. Then we do not necessarily rely on companies to protect their jobs. Japan's system is not strong enough to help individuals rather than companies. Japan tried individual assistance, but that did not happen fully during COVID response. And I think it's really interesting to see the last slide Hoshi-san showed. That is, exactly what I wanted to talk about, which is about corporate savings. I mean, even though the debt level gets high, but cash or corporate savings increased at the same time. But I would say that this is really difficult problem. And I have one guess why there might be not many studies on Japan zombie after the COVID, not COVID, but global financial crisis. One reason is that corporate leverage has been really low, and household leverage has been low as well. We now understand how the context of current pandemic crisis differs from the ones in 1990s. Private sector do not take risk, and financial sector is relatively well capitalized. So I think this is a bit different from the one from the we experienced in 1990s. And as the many large companies showed more resilience than small companies, some may think that corporate savings were useful for survival. But we should focus more on the corporate savings, whether it is good or not. Because increasing corporate savings might imply there is a risk of what is now called secular stagnation, or some may call it Japanification. In the face of huge uncertainty, excess private savings problem arises. So if private sector is not willing to invest, the risk of secular stagnation becomes much more severe. These are my comments on COVID and zombie. Thank you.
Thank you so much, Takeshi, and both of you for very clear setting of the scene. We already have a couple of questions in the Q&A. I have questions of my own. Let me start with a point of clarification. Your last slide, indeed, Takeo was very illuminating on corporate savings going up and at the same time as corporate indebtedness. Can you give us a sense, if you know about it, of how widespread this is? Is it basically the same firms that increase their savings and their indebtedness? Is it different categories of firms? How can we think of it at a micro level and not just at an aggregate level?
Okay, I haven't looked at this figure at the very micro level. We can look at this figure for large firms, medium firms, and small firms, and we find pretty much the same thing. And especially the situation is clear. This type of situation, the both debt and the cash increases, is clearest for the large firms. So they are increasing they are also increasing they have a large cash and increasing the cash, and at the same time they're increasing the loans as well. And at the smaller scale, the small firms are doing the same thing. And there are some anecdote level of stories that we hear, like people. One reason why the Japanese corporations have been increasing the loans is because there's a subsidized loans provided by the government in the form of as a part of a liquidity support, and they get loans. But at the same time, their asset increases. So they buy bonds using those cash. So in a sense, some or many corporations really don't need the loans because they already have a high saving. So they use extra loans to buy the securities or increase the cash or increase the investment, financial investment. So it seems to be the case that the same companies are doing both of these, increasing loans and increasing deposits.
Is there any indication, there's a question from Christoph on the Q&A, is there any indication of how much of that increase in cash is just due to the fact that the loans are coming and the companies are not spending the money immediately, versus retained earnings and cash accumulated by just the fact that there is a drop in expenditures due to COVID?
Probably it's both, and probably there's also a timing thing. The loans come in, and many Japanese companies hold on to those loans just in case, if they don't know how longer the current situation continues. So I think there's definitely timing issues.
Takeshi, any comments on this?
Yeah, I agree what Hoshi-san said. I think the investment of large company has not been strong. Yeah, because of the uncertainty, we don't know what will happen next. So as Hoshi-san said, that this is kind of like just in case issue.
But there's a question whether this is good or a bad thing, right? We have a question in the Q&A from Peter Fisher. Again, on your chart, two questions actually. First, is it likely that the distribution of debt versus cash matters? Finding the mismatch on individual balance sheet is important to determine the number of zombies. So basically, could that kind of indicator be used to identify firms that should be considered zombies? And the second question is it a good thing for financial stability, likelihood of repricing of corporate debt, for the productivity of investment? How do you look at this cash accumulation and debt accumulation at the same time?
So for the first thing, I haven't looked at the distribution of these difference between the companies, so I can't really answer that. But I think that's an important thing for me to look at it. And for the second, if it's a good thing to have the cash, I think that's something Takeshi pointed out. That may not be a good thing, and the Japanese corporations have, in a sense, a very large amount of cash. In a sense, too much cash even before the COVID-19. And I think what many corporations or some corporations are learning now is they are glad that they had that amount of cash. Now they can go through the COVID-19 crisis without much trouble, or there is some trouble, but without much financial trouble. So that may encourage them to increase the cash even further, which may create a problem for the economy as a whole.
Yeah, there's a question from Michael Hollins asking whether we know anything empirically on how the firms have used their increased debt or cash, capital expenditures, keeping the reserves, dividends, buybacks. Do you know anything in the Japanese context that would point to a causal determination in this area? Or is it just too early to tell?
For this time, for the increase of cash in this year, in say second quarter this year, it's too early to tell. But the increase in cash or accumulation of cash have already started. It predates the COVID-19 crisis.
That's right.
And there, the increase in cash is a result of not investing very much, even though the profit increased, and also not paying out in the form of dividends or the share buyback enough.
Takeshi, do you have any empirical analysis that we should be aware of?
I think it's a bit difficult issue. I mean, even though the corporate savings has increased, but some of the corporate savings appear, it just kind of appear as technically. I mean, some Japanese large corporations invest abroad, which appear as corporate savings as well. So we should be careful treating corporate savings as it is. I mean, some of the investment are using as foreign investment. It's really productive. So we should be careful looking at cash or how it is used. Sometimes it is used as a savings just in case, or sometimes it is used as investment in the form of FDI or as a type of investment, not appear as physical investment. So that is one thing we should be careful how the cash or savings is used. But as Nicolas pointed, as Hoshi pointed out, some of the cash are just held as it is. So I think the issue of Japan is what we can do with that kind of like, not just corporate savings, but also household saving as well. During the COVID crisis, household savings increased as well. Probably yesterday, Bank of Japan published one flow funds account report, and it shows how the household savings increased as well. So we can see, we think about, we should think about what we can do on the private savings, even though we have huge public debt as well.
Is there a kind of interplay between the household savings and the corporate financial situation, especially when I think of very small companies? Is it significant in terms of assessing the risk of insolvencies in the future or zombification that the families that control those companies have household savings on their own that can be used to support the company, or does that play a measurable effect in terms of the resilience of the corporate system going forward, that they can get basically cash infusions from the retail household?
It's an interesting question, but I do not know much about it, or at least I cannot see that much from the data at this stage. So probably we should look more on detail.
Yeah, it's a bit of a speculative question, but I have that in Europe as well, because there isn't really a precedent of a major crisis in which household saving is increasing so much as we have during this pandemic. So that's indeed it's a difficult question empirically, but I'm curious about your thinking on how that may play. Takeo, on this?
Yeah, I haven't thought about it, but that's an interesting question. But the household saving, it may have increased this year, but before the COVID-19 crisis, the Japanese household saving rate hasn't been increasing very much, right? Well, it's so there's a long-term trend has been down.
Right.
There had been an increase a little bit.
But down from an initially quite high level by international.
Yeah, down from very initially high rate of saving.
I like.
And also for corporate saving,
No, go ahead.
Go ahead.
Go ahead.
So for the corporate saving, just coming back to what Takeshi said, for the corporate saving, the figure I showed was just the cash and deposit of the corporation. So it doesn't include the investment part. So in a sense, it's a more problematic part of cash and the deposit holding, I think.
I'm wondering about the impact of low rates, and of course, Japan has had low rates for longer than most other economies, actually all other economies, I think. But you mentioned the possibility of debt overhang, and you nuanced it at the end, Takeo. But how should we think of debt overhang when when basically interest rates are minimal? Is there really a notion of debt overhang? And I'm not meaning only at the micro, but also at the macro level. We have a question from Greg Smith about high debt to GDP in Japan. But how should we think of that in the context of low rates? Is that really going to be a constraint going forward?
You mean the corporate debt, right? We are talking about the debt overhang, or the possibility of debt overhang.
Is there?
So even with even with zero interest rate, the debt is a debt, right? So there's a principle that you need to pay back, at least for corporations. Government may be a different story, but so I think there's a possibility of COVID-19, possibility of a debt overhang. And as Takeshi mentioned, I think there's a chance that Japan can use a COVID-19 as an opportunity to change to do the economic restructuring and make corporations more productive, or the corporations had a chance, has a chance to turn around using a COVID-19 as an opportunity. But the possibility of debt overhang may hurt that process, or may slow down, or may inhibit that process. And that's what I worry about. Now, even with the zero interest rate, I think debt is a debt.
Takeshi, Takeo just mentioned the possibility of what I think some people call the pandemic pivot of companies, right? The companies that reinvent themselves because of the disruption of the pandemic and react creatively. Is that something you observe in Japan already? How is that macroeconomically significant, or is it only anecdotes, or is it really leading to a transformation of the corporate sector?
Yeah, I hope transformation of corporate sector will happen. But I think the difficult issue is that we don't know when this pandemic will end. So it's really difficult how this debt overhang issue will appear. I mean, if the COVID crisis is temporary, I don't worry much about the debt overhang issue. Yeah, I worry about, but not that much, because the economy will back to normal, or at least quasi-normal. But it seems that the pandemic will last long. So I hope the business will transform itself. But now I think it's already happening, because as Hoshi-san pointed out in his slide, the effect on employment or effect on industry happens already. So we have to change or transform itself. And it has macroeconomic significant impact as well, because some of the sectors see kind of like really low demand now. So we have to save them, but we need to introduce transformation. So I hope this is a chance for transformation. Sorry, it's really difficult to say.
Yeah, no, I think we're all struggling with this. Actually, I have a number of questions from Philip Oberson, from Toshiyuki Miyoshi, and from Yuta Takanashi on basically the identification and definition of zombies. How do you think about the category of zombies? Is that defined by any financial ratio, or is it something more intangible? How is it distinguished from high debt firms? How do you distinguish firms with debt overhang from zombie firms, especially with the uncertainties about future prospects of the economy and the sector? Who can do that job? That's Toshiyuki Miyoshi's question. And related to that, which practical measures can banks or governments utilize to distinguish viable corporate and unviable corporate in the midst of uncertainty? So lots of questions about what is a zombie, basically. I mean, this is for you, Takeo, because you almost defined the category. So what is the right way to answer that?
So there are two parts to the idea of the zombie firms, or any definition of the zombie firms. One is without any change, without any restructuring, the current business of that company is not profitable. So that's one thing. So if the market was competitive, they would be driven out of the market. But the second point of the zombie firms is, nonetheless, even without restructuring, they can stay in the market. So the zombie firms are those companies which are not profitable, so that they should go out of business, but somehow helped by someone so that they can stay in the market.
but that means this is not captured by a specific financial ratio, right? Because it depends on the business model and business prospects. Is that correct?
Yeah, operationally, it's tough. You need to find out for each company if their business model currently is viable or not, and if there is a chance that they change their business model very quickly. So operationally, what we do, for example, in our paper, is to look at their interest payment and consider if the interest payment is too low compared with current market interest rate, that they are helped by, we assume, or we judge they are helped by the banks and consider them as the zombie firms. So we only look at the aspect of the companies that they are being protected.
But
we don't look into the profitability.
That's for academic research purposes, right? For analytical purposes.
Yes.
But
yeah.
if
that's an operational definition.
Exactly. But if we think of the banks themselves, right? I mean, the banks are on the front line of this process, which you may or may not call triage. I'm not sure if that's the right expression, but basically having to decide which companies deserve being supported over time and which companies do not. How do you think the banks should approach that challenge, and also the governments, to the extent that they manage all those guarantee programs and corporate support programs that you referred to in the case of Japan, but also exist right now similarly in Europe or the US, for example?
So if the bank is, say, for example, maximizing their profit, and it doesn't make sense for them to keep continuing to keep the zombie firms alive, so there would be no zombie problem. But what happened in reality, or what happened in Japan back in late 1990s, at least, was the bank worried about exposing how much bad loans they really have. So they wanted to hide those. And probably more importantly, there was a pressure for the banks to help those corporations because otherwise if the corporations failed, employment get lost. So the people are unemployed, and that creates a problem. And the same thing for the government support, which I'm criticizing here. The government wants to protect even those zombie firms because they want to protect the employment.
Do you think there is a risk of zombification? Sorry, go ahead.
No, so I was going to say that leads to Takeshi's point. That is, when we talk about the zombie firms, we need to also talk about the nature of the safety net. And the problem of Japan is the corporations were expected to work as a safety net, or the corporations were expected to provide safety net to their workers rather than the government. So by replacing the corporate safety net with more better the government safety net may be a good idea for Japan.
Takeshi, do you want to elaborate?
I thought that was what Takeshi was going to.
Yeah.
I mean, I would say that I'm kind of like enjoying lifetime employment. Once I get employed as a lifetime employee, then it is almost little chance to get fired. So we can keep jobs, but we don't need to move to different companies. That is how lifetime employment works. But even for those who cannot get lifetime employment, it's really difficult to enter the system after graduating from college. So it is difficult to get new skills without joining lifetime employment. So that is why I said that we should have more kind of like reasonable system to people get retrained, because the world is changing. We have to get new skills to catch up with how the world changes. But I think, as Hoshi said, that we don't have that kind of like social safety net enough. And that is why we have probably small bunch of people who are attending graduate school or who have kind of a lifetime training. So, but given the world has been changing rapidly, we should catch up with the change. That is another reason why I said, oh, go ahead.
No, a question which is related to that from Jerry Caprio. He's asking, how does the government know what kind of training is needed? Given the structural change, different economic cycles, how is the targeting done?
Yeah, we are always. No, I'm not representing government in this in this answer, but I would say that we understand that the world is changing and we have to catch up with the technological transformation, which I mean that the people need to catch up with the change of digital technology or kind of a development of artificial intelligence or the tech. But Japan is still lagging behind. That is why we don't see much kind of like chance for some industries like Google, Apple, Facebook, or other tech firms has been rising now. But I think we don't see much about that in Japan. So we need to change.
I'd like to move on to the banking.
So I think.
Oh, go ahead.
Okay, go ahead. Well, I was going to say Jerry Caprio's question is great. The retraining, we say retraining program is very important, but there are lots of retraining programs in the world. Many of them are not working very well, I think. And so, but so it's a tough. We need to find out. We need to find the program that works. But we know the retraining programs would be good in theory, but I think there's a problem that we don't really know the model of the model case of the retraining program.
So I'm moving on to the banking system. There's a question from Sam Bunny on whether zombie companies become a systemic risk to the financial system. And there's a related question from Guillaume Adamczyk. From zombie corporates to zombie regional banks, what additional measures can the Japanese government take to prevent zombification of the banking sector, as did happen to a large extent in the 1990s? Can you, the main focus of our discussion has been on corporate zombification, but can you tell us a bit more about the risk of banking sector zombification and also how it played out in the past? There's a question from Alexander Lehman on what adverse effects, so this is really about your paper with Caballero and Kashyap, Takeo, what adverse effects were visible in the Japanese experience when with banking zombification and basically the lessons from the past if it comes to system-wide fragility.
So for the banks, I think there are two things. One is this is not only Japan but worldwide. The banks are now better capitalized compared with the right after the global financial crisis. So there's the banks have a better capacity to take the shock. So that's one good news. But the bad news for Japan, especially for regional banks, is that even before the COVID-19 shock, that they had dealt with, they had some problem firms, mainly the small firms, which were not profitable enough to survive, and some of them are failing in this COVID-19 crisis. And one thing that is important to note is I'm going back to one of the graphs in my slide that shows non-performing loans or the lack of increasing non-performing loans after the global financial crisis. And the major reason for that was the Japanese financial services agencies, Japanese banking regulators' policy to encourage the Japanese banks to roll over the loans to troubled small and medium enterprises. And in return, the regulators allowed those banks to count those loans as normal, not non-performing or the performing loans. And many banks managed to reduce that type of rolled over loans to small firms over time. But even at the beginning of the COVID-19 crisis, the regional banks were suffered from some of those remained hidden non-performing loans. And now the COVID-19 shock can add to that. So I think the situation can be very serious for many regional banks in Japan.
So can you give us a sense of why regional banks have been so difficult to restructure over the last 10, 20 years? Is that a problem of ownership? Because they're dispersed ownership, right? Or is it a problem of governance, political influence? What is preventing the adjustment of the regional bank sector?
My sense is the banks. So in a sense, in extreme sense, the banks are not allowed to fail as the usual corporations. So as a financial regulator doesn't pull the trigger, the banks can continue. And in the so that's a regulation, and also there wasn't enough competition in the regional banking industry to force some restructuring or some mergers and acquisition of the banks in order for them to survive. So I think for those two reasons, the lack of regulators' pressure and also the lack of pressure from the competitive market, the Japanese regional banks continue to survive with a very low profitability.
Takeshi, do you have any view on
now they may be facing,
yes.
Yes.
And there is also action by the regulator, right? Because we've seen the Japanese FSA create, or was it the Bank of Japan? Introducing incentives for mergers recently.
Yeah, both of them have introduced incentives to. I'm not sure if that's the right incentive. Incentive for merging banks. It may give an incentive for bad banks or the weak banks to merge with other weak banks. And that can create a bigger, weaker bank.
Takeshi?
Yeah, this is a really difficult problem, and probably what Hoshi-san said is really important, because we need to care about the incentive of each economic agent. So that's the point we have to think about.
You're leaving us with a lot of open questions. I'll come back to the firm level. There's a question by Alexander Morzov on to what extent the observed rise in credit does reflect the utilization of available credit lines and credit limits rather than new loans. So precautionary borrowing for cash hoarding, drawing on credit lines, as opposed to new lendings that would be, for example, stimulated by government programs, if I get the question right. Takeo, do you have an answer to that?
Yeah, so especially for large firms, there are some of those use of the commitment lines, but the most for medium and small firms, and for most of these, I showed the 30 trillion yen increase of the loans that come from either lending by the government financial institutions or the private banks, which were encouraged by the banks, by the Bank of Japan and the government.
So for small firms,
the government policy has been important.
For the small firms,
yeah, for small and medium firms.
Yeah. Okay. On the restructuring mechanism, so basically you said that what was important is the quality of the restructuring mechanism, even more than the debt levels, right, in terms of the ability to adjust. Can you give us a sense of that in Japan? I mean, has there been bankruptcy reform that gives hope that debt restructuring, the corporate debt restructuring, will become more efficient than in previous cycles? There's a question from Vladimir Papava on this, and also if you have any observation for other jurisdictions. India introduced a major bankruptcy reform recently. It's still largely untested, I guess. There's been a lot of changes in Europe. Everybody wants to emulate Chapter 11 in the US, but that's easier said than done. So what is your thinking on the workout and restructuring mechanisms?
So I don't know very much about Europe. For Japan, I think the situation is much better than in late 1990s. In 2000, there have been an introduction of a new Civil Rehabilitation Act, which tried to come closer to Chapter 11. And also their version of Chapter 11, the Corporate Restructuring Act, that was reformed as well during the 2000s. So those were easier to use, but there are still some problems that people point out. There is a mechanism for outside the court restructuring as well, but most of those are for large firms. And for medium and small firms, there's no equivalent improvement of those procedures, and people worry about what happens.
Do you think the Abe-era corporate governance reform will make a difference? There's a question from an anonymous attendee about them. Will the corporate governance changes in Japan help, or is that basically irrelevant to that discussion?
So again, that was only for the large firms. So small and medium firms, the corporate governance reform so far doesn't matter very much. And even for the large firms, this is in my book with Philip Lipsey on the Abe administration. The form changed very much. Like corporations increased the number of outside directors and so on. Their behavior hasn't changed very much. So,
as a European, I'm shocked to hear that. Takeshi, on this?
Yeah, but I think I think we are always, as I said, that we progressed a lot. As I said, that female labor participation has increased, and the corporate governance reform has been increased, has been progressing. So it's still unfinished, but we see the positive side as well. And probably we have yet to see the substances, maybe, but I think return on equity has been increasing, and not just by share buybacks, but also increasing the profitability as well. So I think we can see the positive side of the corporate governance reform as well. Yeah, even though it targets mainly on large firms, but we are now trying to reform the small, medium enterprises as well. So let's see what will happen.
We're getting close to the end of our session. I have a question. Obviously, the news flow of the last few weeks has been very much about the vaccine and possibly, seeing the light at the end of the proverbial tunnel. And that raises very difficult questions, of course, on the timing of adjustment and moving to what you call the new normal, because it's dangerous to lift extraordinary support too early, but it can be also dangerous to wait too long before lifting it. And that's what the whole trade-offs about zombies are about. So there's there's a question which I'm afraid will be the last for the session from Yuta Takanashi. How should the government decide when to exit from extraordinary measures such as loan moratoria or encouraging banks to use capital buffers to support the economy? So this is really targeted at the financial sector part of it. Is there any metrics that the government should rely on? Maybe both of you, and any concluding remarks. Takeo?
So I'm not sure if there's any simple metric that the government can use. And in any event, I don't think that's what the Japanese government or the government tried to decide. What the government should do is to improve the restructuring process, as we talked about, like for corporate rehabilitation and so on, so that the private sector can use those for better restructuring when the time comes.
Takeshi?
Yeah, I concur with Hoshi Takeo-san, but I would say that too early withdrawal from stimulus is probably a risk. Always, or anywhere, not just in Japan, but also in other countries as well. Some stimulus packages were withdrawn too early. So COVID crisis, we don't know when the vaccine available for everyone or when the pandemic will end. So the risk is probably too early withdrawal.
Yeah, and that argument in the context of the concern about zombie firms has been made similarly as you just did by my Peterson Institute colleague, Joe Gagnon, in the context of the United States. Indeed, the risk of, in the light of the previous crisis, the risk of normalizing too early is clearly there. Well, as usual, there are many questions that we haven't been able to answer. There are questions from Carlos Carpi, for example, on bank resolution in Japan, which I think would deserve a whole separate session. And we'll come back to that in future sessions of the series in 2021. I want to thank both of you very warmly, Professor Takeo Hoshi and my colleague at the Peterson Institute, Takeshi Tashiro, for a very rich discussion. I learned a lot. I think our audience learned a lot. And we're very grateful for all the insight. Thank you very much. The next session will be obviously in the new year on January 13, and we will talk about a related topic, which is apparently very technical, actually very contentious, the impairment and provisioning of problem assets, so measurement issues from an accounting and regulatory perspective. And we will do that with Bill Cohen, the former Secretary General of the Basel Committee, who is now the chair of the Advisory Council of the International Financial Reporting Standards Foundation, and my colleague Adnan Mazarei. With that, I wish all of you happy holidays. I hope everybody takes time off because I think we all deserve it. And very much looking forward to seeing you in the new year with, again, special thanks to our two speakers today. Thanks very much.